Hello, I'm Pat O'Hare, Editor-in-Chief of Briefing.com's Investor Service. In this Learning Center segment, we will be defining the price-to-book ratio. To determine the price-to-book ratio, you have to first figure a company's book value, which is essentially the difference between total assets and total liabilities. Put another way, the book value is the equity shareholders have in a company that in turn provides a sense of what the company's liquidation value would be in the event of a bankruptcy. Once the book value has been determined, you can compute a price-to-book ratio by taking the stock price and dividing it by the book value per share. A number below 1 indicates a stock is trading below its book value and arguably offers a compelling value proposition for investors. That isn't always the case though, so when looking at such stocks you need to take into account the company's operating performance to ascertain whether the discount to book value is indeed a value-based opportunity or the result of a serious fundamental shortcoming that could have you falling into a value trap. The price-to-book ratio is a more relevant valuation metric for companies that commit a lot of capital to infrastructure development, such as home builders or manufacturers, in their bid to make a profit. It is less useful in other instances, such as valuing technology companies which don't have a lot of hard assets. The price-to-book ratio, however, is a primary valuation metric for the financial sector, where the vast majority of assets and liabilities are constantly assessed by their market value. Finally, while the price-to-book ratio is a key valuation metric for some industries, it, like any other valuation metric, should not be considered as the sole factor in your valuation assessment. That wraps up our Learning Center segment on the price-to-book ratio. Thanks for listening.